Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Resources Pharmaceutical Group Limited Annual Report. China Resources Pharmaceutical Group Limited offers a wide range of pharmaceutical products and services through its four main segments: pharmaceutical manufacturing, pharmaceutical distribution, pharmaceutical retail, and others. The company manufactures and distributes various types of drugs, including chemical drugs, Chinese medicines, and biological drugs. Its product portfolio covers multiple therapeutic areas such as cardiovascular diseases, respiratory diseases, orthopedics, and more. The company also provides nutritional and healthcare products for specific conditions like pediatrics and genitourinary system disorders. In addition to its manufacturing and distribution activities, China Resources Pharmaceutical Group Limited operates retail pharmacies under the Tech Soon Hong brand. It offers warehousing, logistics, and other value-added pharmaceutical supply chain solutions to manufacturers and dispensers such as hospitals, distributors, and retail pharmacies. The company distributes its products under various brands including 999, Dongyi Jiao, Double Crane, Zizhu, Jiangzheng, Boya, and Kunzhong Yao. Its services also include property holding activities and related pharmaceutical supply chain solutions. China Resources Pharmaceutical Group Limited market capitalization of 35 billion is significantly larger than the average industry peer of roughly 2 billion. This shows that China Resources Pharmaceutical Group Limited holds a significant advantage in their industry. China Resources Pharmaceutical Group Limited trades at a lower price-to-earnings ratio of 8 times and a lower price-to-book ratio of 0.62 times relative within the industry. This suggests a potential market detachment, as China Resources Pharmaceutical Group Limited trades at discounted levels, while the broader industry remains fairly valued, warranting deeper fundamental analysis. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 3.9%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a pharmaceutical company can be attributed to several key factors. The sale of pharmaceutical products has shown significant growth, with an increase of 12.1% from 2024 to 2025. This is largely due to the success of various product lines, including prescription drugs, biological drugs, and nutraceuticals. The manufacturing segment revenue has also seen a substantial increase of 31.5%, while the distribution segment revenue has grown by 3.7%. The company's expansion into overseas markets through its international development strategy has contributed significantly to revenue growth. Additionally, the launch of new products such as Brivudine tablets and Tenepocide has led to impressive year-on-year growth. The company's online sales have also seen a significant increase of 45% year-on-year, while its Royal Weikang 1619 series has experienced an astonishing 180% year-on-year surge. The launch of the Excellent Service platform has streamlined operations and saved over 16,000 hours of manual labor. On the other hand, the primary drivers of revenue decline are limited to a few areas. The chemical OTC drug business has seen a decline in revenue from the pediatric field, while the chemical prescription drug business has experienced declines in revenue from infusion therapy and anti-infective fields. However, these declines appear to be relatively minor compared to the overall growth achieved by the company. The net income of the company saw a significant increase of 14.9% to RMB 9,653 million. This growth can be attributed to various factors that positively impacted the company's financial performance. One key factor contributing to this growth is the improvement in profit margins. the gross profit margin increased by a substantial 43.6 percentage points, rising from 16.5% to 60.5%. This significant jump was achieved through optimization of product structures, technological advancements, and enhanced efficiency in production. As a result, the company was able to maximize its revenue while minimizing costs. In contrast, the profit margins for the pharmaceutical distribution business decreased by 0.1 percentage points to 5.8%, while those for the pharmaceutical retail business increased by 0.2 percentage points to 6.4%. These variations in profit margins across different business segments highlight the company's efforts to adapt and optimize its operations to suit changing market conditions. Overall, the increase in net income and significant improvement in gross profit margin demonstrate the company's ability to navigate challenges and capitalize on opportunities, ultimately leading to improved financial performance. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest data, net cash from operating activities reached RMB 20,476.3 million in 2025, marking a substantial increase from the previous year's figure of RMB 17,535.5 million. This upward trend is a clear indication that the company is successfully generating positive operating cash flow, a crucial metric for assessing its financial health and stability. The company's debt level has undergone significant changes in recent years. While the total debt level decreased by 4.6% from RMB 60,568.5 million to RMB 58,820.2 million, a closer look at the non-current liabilities reveals a more complex picture. The decrease in non-current liabilities was substantial, with a reduction of -37.4%. However, this decline is somewhat offset by the increase in debt level mentioned on page 4. In terms of interest expenses, there has been a notable decrease. Interest on borrowings decreased by RMB 226,392 from RMB 1,971,643 to RMB 1,745,251. Additionally, net finance costs also saw a decline of RMB 58,220, dropping from RMB 1,600,779 to RMB 542,559. These reductions indicate that the company has managed to lower its interest expenses in recent years. The company's performance was mixed across various segments and regions. On the positive side, the manufacturing segment saw significant revenue growth, with a notable increase in the pharmaceutical manufacturing segment. The distribution segment also performed well, driven by strong sales in the pharmaceutical distribution segment. Overseas markets, including Hong Kong, Macau, Asia, Africa, Southeast Asia, and Taiwan, all showed improvement. In addition, the pharmaceutical retail business experienced a 20.8% year-on-year increase, with the direct-to-patient (DTP) business growing at an even faster rate of 19.4%. These positive trends suggest that the company's focus on pharmaceuticals is paying off. However, not all segments and regions fared as well. The retail segment struggled, with revenue declining significantly. The others segment also underperformed, likely due to a decrease in gross rental income from investment property. Management is emphasizing the company's focus on cutting-edge fields such as antibodies, ADCs, gene and cell therapies, nucleic acid drugs, vaccines, and high-end medical devices. This strategic shift aims to establish a competitive advantage through both in-house research and development and external collaborations. To achieve this goal, the company plans to build a comprehensive R&D platform that integrates traditional Chinese medicine, TCM, chemical drugs, and biological drugs. By doing so, management is confident that the group will be well-positioned to capitalize on emerging trends and stay ahead of the competition in the industry. There is no notable activity to report on acquisitions and divestitures. The company has not engaged in any significant transactions involving the purchase of other businesses or assets, nor has it sold off any major divisions or subsidiaries. This lack of activity suggests a stable and focused approach to business operations. The company has a history of paying dividends to its shareholders. In recent years, it has declared both interim and final dividends. For instance, in 2025, an interim dividend of RMB 452,340 was paid out, while a proposed final dividend of RMB and $66 million is set to be distributed. This demonstrates the company's commitment to returning value to its investors through dividend payments. There are concerns about inventory buildup or supply chain disruption in the company's operations. The significant increase in manufacturing and distribution segment revenue on page 10 indicates a potential for inventory management issues. Furthermore, the substantial rise in intersegment sales on page 11 suggests that there may be an accumulation of inventory, which could lead to supply chain disruptions if not managed properly. The launch of a drug traceability code platform on page 37 implies that there are underlying supply chain issues that need to be addressed. This initiative may be a response to existing problems or a proactive measure to prevent future disruptions. Regardless, it highlights the importance of maintaining a reliable and efficient supply chain in the company's operations. That concludes the financial summary for China Resources Pharmaceutical Group Limited. Feel free to comment below, and I will be happy to answer them when possible.